Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall talk about, or we shall answer the question, if inflation is going to be re-established, if the world once again is going to go into an economic downturn, it's going to be the same situation which happened post-COVID when the expenses incurred to fight the pandemic led to inflationary pressures all around the world. And if the current war is going to bring back those inflationary pressures through the rise in the energy prices caused by the blockage or the disruption of the traffic through Strait of Hormuz. We shall look at the short term, the medium term, and the long-term effects of the war and the way these effects need to be treated and handled by us traders and investors. Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall talk about the asset classes and their behavior under the new normal, which has been brought in by the recent Israel-US-Iran war, establishing 4 different sets of factors affecting the price estimation and valuation of different assets. The first and foremost is the effect of war-related rumors, which may be affecting the prices over a short duration, but it may be enough to take someone out of his/her trade proceeding in the right direction. The second factor is the analysis carried out by various war analysts, political analysts, and economic analysts. The divergence in the conclusion derived by various analysts could also be a cause of the volatility induced in the market. The third factor is the actual effect on the supply of goods, majorly energy products, due to the disruption of traffic in the Strait of Hormuz. And the last one being the news from data docket, which during normal circumstances allows economists and market players to alter/maintain the value of goods and services traded in the market. However, the data docket has been seen to be more or less ignored in the current situation because of the geopolitical news and different kinds of rumors, as well as news floating around and overshadowing all decisions. One very important change seen in the last 16 days is the revision of the estimation of the possibility of economic downturn in the war-affected economies, which in turn would also affect the global economic conditions in the short to medium term. The stock markets have made substantial losses in the last 2 weeks and may continue to do so, with some of the big names losing a considerable amount of their market cap should the situation not improve in the forthcoming week or the weeks thereafter. On today's video, we shall talk about US oil, gold, silver, the US dollar index, and NASDAQ. We shall see the possibilities of deciding whether to stay on the sideline or get in to get some quick profits and come out of the market. Disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material is obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 33rd of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities, investment, and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, or guide anyone to take any trade based on the contents of this video. And we do not take any responsibility for partial/total losses arising out of trades based on the contents of this video. And it is the daily chart. We've been visiting this chart over the last 5 to 6 weeks regularly, and we've seen the move to be a range bound move between 95.45 and 100 being the upper limit. it has not been able to break out of this range since the time that it started in the month of April 2025, and it's this particular week, after the war entered its second week, that the US dollar index has printed 4 bullish candles in a row. Out of them, the last 3 candles have been nice, good rallies, and it has managed to close above the range established during the last 9 to 10 months. The recent close was at 100.107, and if the conditions stay the same, then there would be a chance for the index to break out, and it may get held up in the supply area right above, which is between 101.077 and 101.887. But going by the newly established estimation of an economic downturn in the United States of America and an expectation of re-establishment of inflation, which could prevent the Fed from going for a rate cut in the next meeting at Wednesday next week, or in their future meetings up until such time that inflation is corrected. Then the US index, or the US dollar index, is poised to break out and establish an uptrend in the near future, or the near to short-term future. The only way that the dollar index could reverse would be for the oil prices to go below $70 a barrel, which was the range established during the last one and a half to 2 years, and then inflation has to come under control, which would allow the Fed to start cutting the rates a second time again. See in front of us is that of XAU/USD, which is the ETF based in gold, and it is the weekly chart in front of us. Why we're looking at the weekly chart is purely because we'd like to first see the bigger picture and then dive deeper into the daily and the 2 4-minute charts. On the weekly chart, we can see that there were 3 very explosive moves in the month of January, followed by some smaller rallies in the month of February. But gold has printed 2 red candles and is currently evenly poised between its high at 5600 and the recent low that it touched, which was at 4400. So therefore, as of now, gold could go either way and hasn't been very much affected by the ongoing war between Israel, US and Iran. On the daily chart, we see that there are 2 good controlling bearish areas, one between 5400 to 5600, and the second one, which has been recently printed, is that between 5263 and 5411. But there were 2 nice bullish areas also printed. The first one being in the beginning of February, which was the explosive move that we talked about on the weekly chart. And then we've got this area, which is lying between 4846 and 5024. So this particular area, the bullish area, is the one which is now countering the bearish move, or the move taken by the sellers to bring down the price of the asset below the 5000 area, somewhere into the 4800 to 4700 area, before it tries to move further down to 4400. However, if the bulls or the number of buy orders are enough for turning the move around, then we could see it going back up again in the range bound fashion that it has been during the last 6 to 8 sessions, and could again come up to 5200 to test this newly established daily supply area. But until then, we must need to watch if gold is going to break down or will it go back up and try to break this bearish area. So the trade as of now is basically the sell trade, which one could take at 5200, but do not try to get into a buy trade at the 5000 area, although it happens to be a nice psychological areas to attract the buyers or the bulls. Of XAG USD, which is the ETF based on silver, and again this is the weekly chart that we're looking at, like what we did on gold this time as well. We shall first look at the higher time frame, where we can see some very explosive candles in silver as well, and these were the candles printed in December, January and the beginning of February. But the most explosive of them all was the candle printed during the last week of January, which touched the all-time high or the all-time recent high at 121, and the lower part of the candle, the wick, ended at about 73.38, followed by another bearish candle, which although is a red candle, but we cannot call it bearish because it finally retraced all its losses and closed above the lower end of the wick from the previous week. Now in the last 2 weeks, similar to gold, silver as well has printed red candles. Once we go into the daily chart, we can see that silver has been more or less in a sideways movement, although there have been a couple of higher lows established. The first higher low is the one at 73 to 75, and the second one is at around 80, where the current candle has closed, where the candle on Friday closed at 80.32. And if you look on the bearish side, we have got a formally established lower high and then one more lower high last week. So one could actually think of getting into a short trade on silver if the current trend gets established after breaking below 70. We must see a nice explosive move from 80 all the way to 70 or anywhere below this area in order to confirm the establishment of a downtrend temporarily, or at least for the time being. Similar to gold, silver as well hasn't shown any explosive moves under the effect of the war, and we can safely take trades based on technical analysis on silver. The chart that we have in front of us is that of US oil spot, and it is the weekly chart. Once again, we're looking at the weekly chart to establish the amount of supplies or sellers areas taken out by US oil spot in just 1 week. As one can see, it broke out of its area in between 60 to 66, where it was trading the previous week before the war broke out. But as the war broke out, it took out all the suppliers on the left hand side until it touched its high or the recent high at 115. After touching its high, it receded again under the influence of news, purely because people felt that the war would go on for a long time and the disruption of supply in the Strait of Hormuz would come to an end very quickly. However, this hasn't happened, and now people are trying to establish a trend for this particular asset under the influence of news and not under economic conditions. Everybody is trying to guess or trying to reach a figure which the price could attain if the supply under circumstances could go on diminishing during the next few weeks. That's one of the reasons why it has printed consecutive blue candles in the last 4 trading days. It's purely because of the analyst's expectation of the reduction of supply of crude light or crude in any form. But the moves haven't been very explosive purely because of the announcement of certain reserves becoming available to the buyers in the next few days. One needs to still see if there is a supply area that can be printed in the next 1 week or later before thinking of attempting any kind of show. As of now, the best trade is still a long in the area of 70 to 73 or 77, but it's always better to try and go long below this particular wick at 76.21, as there's a nice buyer's area supporting this particular bullish candle. Wait for the price to reverse into this zone or wait for another demand zone or a buyer's zone to establish before going into a long. And if you wish to go short, please wait for red candles to be printed and form a nice supply area anywhere above the current level. What we see in front of us is that of Nasdaq, and we're looking at the daily chart. Why we're not looking at the weekly chart is purely because of the levels and the patterns that can be clearly seen on the daily chart. One cannot see them on the weekly chart. The index was in an uptrend throughout 2025, right from April up until November 2025. It established its highest high, which is at about 26,819, and then it came down to establish a new low which was below the previously established low at around 25,097. The new buyer's area or the demand area created in the area of 24,403 held on for quite some time. This was created in the month of December, and it maintained to counter all the bearish moves up until February 1st week, when the index once again revisited this particular low, which was 24,403, and then on it has not been able to break above 25,714, and a new seller's area or a bearish area has been established, which is a lower high as compared to the previous high established in November. we have got a sideways movement for the time being under the influence of the Israel-US-Iraq war. But if it tries to break below 24,403 and close below 23,497, then we shall certainly have a new lower high established at around 25,148, and one can say that we have a temporary downtrend in function. But up until then, we can say that the index is still in a sideways move, and if we could get a bullish momentum and break above 26,230, then the sideways move would continue, and if the index breaks above 26,819, then the uptrend restarts. That's how the index has to be treated. But as of now, the best trade would be to short at the currently established bearish area between 25,714 and 26,230. That's the area which could give us a safe short with a target at around 24,410 or slightly higher to come out of the trade as quickly as possible before it reverses out of the long established bullish area, which is still holding very strongly. Ladies and gentlemen, traders and investors, we hope that the contents of our presentation was informative enough and exciting enough for you to come back and watch all our videos every week. We shall continue with our weekly analysis and shall be touching upon asset classes / events, which were the highlights of the week, and discuss the interesting and eye-catching moves during the week. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega. Watch all our videos and please visit our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. We thank you for watching our video. Please like, share and subscribe to our channel Polo Vega.